Assalamualaikum, I bid to Madam Bedah binti Ahmad. We are from group AC2205A and we are going to present on our group project. For the introduction, this group project is to understand the definition of efficiency market hypothesis and their implication for performance on mutual funds. Next, it is to focus on the capital market events and anomalies exposed by empirical research that were inconsistent with the view of markets as fundamentally rational and efficient. And lastly, is to comment on Lori Puglia's ability to consistently outperform the market and whether his success is just on luck.
I'm IMAN SYAFIQAH and I'm going to explain question 1. Efficient market hypothesis (EMH) is a market theory that evolved from a 1960s PhD dissertation by Aguna Pharma. EMH states that at any given time and in a liquid market, security prices fully reflect all available information. It states that it is impossible to beat the market because stock market efficiency causes existing shares price to always incorporate and reflect all relevant information. According to EMH, stock always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it is impossible to outperform the overall market through expert stock selection or market timing. The EMH exists in various degrees: weak, semi-strong, and strong, with inclusion of non-public information in market prices. If the market is a semi-strong form efficient, then no matter what publicly available information mutual fund managers rely on to pick stocks, their average returns should be the same as those of the average investors in the market as a whole. It is usually tested by comparing the performance of professionally managed mutual funds with the performance of a market index.
My name is SITI KHAIRIANI and I will explain question 2. For question 2, market efficiency hypothesis suggests that markets are rational and their prices fully reflect all available information. Due to the timely action of investors, prices of stock quickly adjust to the new information and reflect all the available information. So, Puglia's results seem to contradict conventional academic theories, as no investor can beat the market by generating abnormal returns. With reference to the case, it is shown that they were inconsistent with the view of markets as fundamentally rational and efficient. This is because the company had generated superior returns on average over the life of the fund. Since the inception in mid-1993 through September 30, 2016, the fund had returned an average total return of 10.12%, outperforming the 9.12% return of the fund's benchmark, the Standard Poor's 500 index. Puglia had served his investor well by performing better than competitors' fund in both bull market, a market in which share prices are rising, encouraging buying, and bear markets, a market in which share prices are falling, encouraging selling. For most fund managers, beating the S&P 500 in any single year will be an accomplishment. However, according to Exhibit 2, the report shows that the trailing total returns of the fund always beat the S&P 500.
My name is MAIZATUL and I am going to explain on question number 3. Larry J. Puglia had been managing the T. Rowe Price Blue Chip Growth Fund for over 23 years. Puglia had been the sole manager of the mutual fund since 1997 and had generated superior returns on average for his investors over the life of the fund. He has his own talent, skills, and already experiencing many situations in trading world. As we can see in Exhibit 1, Most of their top holdings are large companies such as Amazon, Microsoft, and Facebook. These are well-known companies. It is clear that they focus on the highest quality companies, especially related to technologies, which has the ability to generate strong cash inflow and the financial strength to withstand a potentially deep and prolonged economic recession. The summary of the Blue Chip Growth Fund shows the increasing of all stock market price (XNAS), the large growth as well as the index market S&P 500. However, XNAS shows the highest value among all. This indicates that the price of the Blue Chip Growth Fund is the highest and therefore it beats the index market. Puglia rarely had the best overall performance in any given year, and other managers had beaten his results over a short-term period. However, his overall long-term performance relative to the index was very impressive. He is a goal-oriented person who has bigger vision than others.
My name is NURUL binti RAHMAN, and I will continue the answer for question number 3. In Exhibit 2, the trailing total return blue chip increased rapidly among others. This indicates that the high book value to stock price ratios outperform stock with low ratios. This shows that blue chip growth fund beats the market. Their stock returns keep on growing over the years, especially after Larry Puglia was nominated as one of 5 finalists in 2013. The Blue Chip Growth Fund itself was awarded by Investors Business Daily (IBD) as an IBD Best Mutual Fund 2016. Their good reputation may have influenced more investors to invest, which contribute the increase in their stock value. So, we disagree with the claim that Larry Puglia's success is a pure luck. Puglia's skills and ability in managing mutual fund was recognized by many people. Managers' obligation of providing investors with a high level of confidence is very important strategy. Experience implies knowledge and skill acquired over time. Personally, we believe that the experience of managing assets over a long periods of time in both favorable and unfavorable environments can be advantageous to overall portfolio return. The longer the time range, the greater the value created. For conclusion, we can conclude that EMH provides ideal situation where the stock price reflects all relevant information in a competitive market. However, EMH fails to explain the empirical challenge in the context of market efficiency because of the factors of market sentiment and investors' level of confidence tend to increase and decrease depending on the situation. That's all from us. Thank you.